Good afternoon, ladies and gentlemen. Welcome to the Belvoir Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab just situated on the right-hand corner of your screen. Just simply type in your questions at any time and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you give that your kind attention, I'm sure the company would be most grateful. I'd now like to hand over to Louise George, CFO, and CEO Dorian Gonzalez. Good afternoon.
Hi there. Thank you for the very kind introduction, and I'll just make my screen full, which I've just done. And thanks to everyone in advance for listening to this presentation. The sort of format is that I normally sort of run through 6 or 7 slides at the beginning, and then really to talk about the general overview and the sort of structure of the business in case anybody hasn't been following our story. The middle section, Louise will deliver. That's the financial review, and then I'll come back towards the end to talk about the markets that we operate in, i.e. estate agency, lettings and financial services. Normally we get quite a few questions around the sort of housing market and the lettings market, so I'll cover that towards the end of the presentation, and time permitting we'll then open up to everybody to ask questions. So please feel free to submit any questions, and we'll tackle as many as we can before the end of the session. Okay, so onto the first slide. Apologies to anybody if you follow our story, but I'll do an introduction for any sort of new listeners. So first off, my name's Dorian. 24 years experience in the property sector. I've only ever worked for 2 property companies, one being Countrywide and the second being Belvoir. I'm just coming into my sort of 18th year with Belvoir. I originally joined the founders many years ago, and we've sort of built the business over the last 20 years. I do have shares in the business, as you can see on the screen, and Louise has updated our share options, which are performance related. Louise joined us 8 years ago, and when I sort of think back to what the business looked like 8 years ago, it was incredible because we only had one single brand at that point. We didn't have any estate agency, no financial services, we weren't involved in anything apart from residential property management, and we changed a lot over the last sort of 8 years. Louise again has steadily built up a holding in the business over the last few years, and Louise's holding is on the screen. So that's just a brief introduction to both of us, and as I said earlier, we will both present through the slide deck. So really just a few sort of financial highlights to begin with. So revenue, very pleased to say, is up 15.4, is up 12% to 15.4 million. Our revenue has sort of steadily been increasing, and if you look at all our revenue as a whole, broadly speaking, you can say half of our revenue relates to financial services, and around half of our revenue relates to property. And then if you look at the property half of the revenue and drill down a little bit deeper, around 80% of the half of our revenue relates to property management or lettings. This is where we look after properties on behalf of landlords. So 80% of our sort of half of the property revenue is recurring, and 20% of the property revenue that we generate comes from estate agency. So I just wanted to dispel any myths. We look like we're an estate agency business, but actually most of our property revenue actually comes from property management, from lettings. So our profit before tax is down in H1 this year versus H1 last year, and it's fairly easy to understand why, and I'll point out the main factors, and then Louise will give you a full breakdown within her section. So firstly, H1 this year, we've returned to business as normal, and we're out supporting our franchisees. We're travelling around the country. Louise and I, for example, this afternoon we're heading off to London, and we're back to face-to-face investor meetings as of tomorrow. So the business really, in terms of its cost base, has returned back to its pre-COVID level, slightly higher because some costs have gone up clearly. We've had some modest wage growth of around 5% versus H1 last year. And there are numerous other factors that have sort of contributed to to this. But the bottom line is, this time last year we were in lockdown effectively, and now it's sort of business as normal. And I say Louise will give much more colour around the numbers within her section. EPS therefore is also down by 12% to 8.7p, and net debt has reduced to 2.5 million, which is down 36% compared with H1 last year. Operationally, our office numbers have increased, so we're now at 473 offices versus 467 this time last year. Our FS business is performing extremely well, so we've added a further 80 mortgage advisors to our business compared with H1 last year. Most of those have come via acquisition. We completed on a business in May this year called Time, that we only saw a month of the upside of Time in this half. The main upside comes in H2 this year. House sales, which is the other contributory factor, the main contributory factor in terms of a profit adjustment. So we forecast 12 months ago that 2022 would really see a return to pre-COVID levels of house sales. And what I mean by pre-COVID levels of house sales is that during the sort of years of 2016, 17, 18 and 19, across the UK, we saw around 1.2 million property sales. So 1.2 million being the baseline as I see it. Then 2020 happened and property sales fell from 1.2 million to 1 million. So some estate agents were closed for a short period. Surveyors couldn't get into properties to undertake surveys. Therefore, there were fewer transactions in 2020. And then in 2021, it jumped from 1 million in 2020 to 1.5 million in 2021, mainly thanks to stamp duty holiday, but also due to COVID and behavioural factors, a race for space as people wanted more space in their properties, fear of missing out. So when the property market starts to get quite heated, some buyers sort of race to make the next move quickly, just in case they can't afford to make that move in sort of 6 or 12 months time. So it's that sort of fear of missing out on the ideal property. And the sort of net effect of this is that we saw last year 1.5 million sales. It was way above the normal level. So what's happened in the first half of this year is that sales across the UK have fallen by 29% to exactly just under 600,000 sales. So we have returned to exactly where we said we would return to, and that's had an impact on our business. So we're 21% down in property sales. So in a nutshell, what's happened in H1 this year versus H1 last year is that the market and the business has normalised back to sort of pre-COVID levels. So hopefully all of that makes sense, but we'll add a bit more colour later on. Number of managed properties is the last number on here. This is very important to us because we're at the heart of our business. We are a residential lettings business. So 80% of our property revenue, as I've said, comes from lettings, not the estate agency. And lettings revenue is recurring, so tenants continue to pay their rent. We charge a management fee for managing the property on behalf of the landlord, and we're very good property managers. We've got over 2,000 sort of franchisees and staff of franchisees who are very skilled in property management, and the portfolio continues to grow each year. We do feel that we can grow the portfolio even further into the future. I'll move on to that later on. So just to give you an idea, I mentioned on the first slide that we've got 473 group offices, and this is how that number is made up. So we've got 159 Belvoir offices. Belvoir is mainly lettings, so 90% of the revenue that franchisees generate in Belvoir comes from lettings. Newton Fallowell with 39, and that's primarily an estate agency business. Northwood, very similar to Belvoir, that's a residential lettings business mainly. Northwood specialises in what's called guaranteed rent or primary tenancy. And again, if you followed our story, you'll understand that, or feel free to ask questions towards the end. Lavelle, the business that we acquired at the beginning of 2020, the timing couldn't have been worse, and COVID sort of broke, a few months after completion. But actually, then the sales market became very busy, and we're very pleased to have Lavelle on board. And then In more recent sort of months, we acquired Humphreys partway through 2021. Mr. and Mrs. Clark, we acquired just a very small personal agent business. So Mr. and Mrs. Clark is the only model that we operate whereby you don't need retail premises. So if you're a franchisee and you want to join our business because it's performing well, but you don't want to invest in a retail unit, that you can join us via Mr. and Mrs. Clark now, which is a personal agent model. It's a brand new sort of acquisition. We acquired it a few months ago, and we will grow that business going forward. Additionally, we also dual brand a number of offices with the Nottingham Building Society, and if you tally all of those up, along with the mortgage business, that equates to 473 offices. Just a last sort of point on this slide is that, again, at the heart of our business, we are a franchise business, so we have no plans to become a corporate. In Belvoir, for example, of the 159 offices, we own one of them. The other 158 have got a franchisee who owns and operates the business. And interestingly, even during the COVID year, we outperformed our pre-COVID market expectations in 2020. And the main reason for that is that we've got franchisees at the heart of these businesses with 100% skin in the game. And these franchisees really want to grow their businesses every single year. So as you can tell, I'm hugely passionate about franchising. Okay, so I'll talk about just some of the opportunities that we're currently working on. Assisted acquisition strategy. So what this is, over the last 8 years, we have helped our franchisees to grow their lettings businesses by helping franchisees to acquire competitors, their own competitors. Just to give you some perspective around that, in the last 8 years, we've helped franchisees to acquire around 120 businesses. So we're good at it. Franchisees see all the benefits of doing it, and it's very profitable for the franchisee and for us, the franchisor. Up until COVID, we built up quite a momentum in what we call assisted acquisitions. And in 2019, we helped our franchisees to bring on about 6.5 million of extra revenue in 2019 from these acquisitions. So it was going great. Then 2020 hit, the world changed, and our franchisees said, we're not acquiring in 2020. They just, for obvious reasons, they thought it was a bad idea to acquire while the sort of world was in flux. And I have to say I agreed with them. Then in 2021, we saw a very active sort of sales market whereby there were fewer sellers around. And so we didn't build up any sort of head of steam on franchise acquisitions last year. And in fact, we finished last year helping franchisees to acquire just 1.5 million of extra revenue by acquisition. You may remember that a few minutes ago I said in 2019 that was 6.5 million, so it dropped a lot. I'm very pleased to say that in the first half of this year, we have already helped our franchisees to acquire 2.2 million of extra revenue from acquisitions. So we've outperformed last year and the year before, and we have 4.4 million of other deals in a pipeline with solicitors of franchisee deals that we expect will complete in H2. So clearly some of those deals could fall through, but I suspect the majority of them will go through. Point being that we're back up to sort of full momentum in terms of franchisee acquisitions, which I'm really pleased about. And the acquisitions in the first half of this year have added 1,800 properties to our portfolio. We're expecting a deal to complete before 5 o'clock today, which is about a 400k sort of revenue deal, franchisee revenue deal, and we've got sort of more to come. So that's just an update on acquisitions. Mr. and Mrs. Clark, I touched on earlier. It's very early days for us, so it's a small business. We haven't invested a great deal in it, but actually we like the principle of having a personal agent franchise model, so we've acquired one. Mr. and Mrs. Clark, the humans, have also joined us, as well as us acquiring 100% of their share capital. We've had Mr. and Mrs. Clark join us too, and we're working very closely with them to obviously grow this business in the coming years. So I won't say much more about that because it's just too early, but sort of watch this space. Time Group, I mentioned earlier. Good acquisition. We made this in May this year. It fits our profile perfectly. Revenue of 4.2 million, and profits of 0.7 million for the year to July. We completed on this deal in May, so we haven't seen the upside yet. The upside comes in the second half of the year, but that's another 63 financial services or mortgage advisors who have joined the business. Okay, so I'll pass across to Louise to really run through the numbers, and then I'll come back and talk about the markets in the third section.
Hi. So if we have a look at the business, I think it would be fair to say that 2021 was always going to be a hard act to follow, given the way the market operated last year, obviously supported by things like the stamp duty holiday. But anyway, we grew our revenue by 12%. 11% of that came from effectively acquired growth, businesses that we acquired during 2021 and 22, the comparative. And then we had 1% of organic growth. So looking at the property division, revenue from the property division was up 4%. The acquisitions added 8%. So just to remind on those acquisitions, we acquired Nicholas Humphreys halfway during the first half of last year, so at the end of March 2021. So we had a full 6 months of trading from it in this half year compared to last half year. And then we had a little bit of Mr. and Mrs. Clark that we acquired in March 2022. So that added 8% to the property revenue, and the like-for-like revenue from property was 4% lower, which is pretty much as we expected because of what we were seeing, what we anticipated happening on the sales, in the sales market. Financial services was up 20%. The acquisitions there added 14% of revenue. So a little recap, we acquired Nottingham Mortgage Services in July last year. That was the mortgage arm of the Nottingham Building Society. Fairly small acquisition. We spent about 600,000 on it. So that came on board then. So we've had the full half year benefit of that in 2022. And then we acquired the Time Group on the 23rd of May. So we had about 5 weeks of that in this year. So they added 14% to financial services revenue, and the like-for-like business grew by 6%. Overall gross profit was up 5% to 9.4 million. And one of the things that's interesting, is probably worth sort of just teasing out a little bit more detail, is the movement in the gross margin. So when you look at the overall gross margin, it's 61%, down from 65% in the first half of last year. The reason for this is twofold. So first of all, the bigger proportion that financial services becomes of our revenue. So last year it was 46%, this year it's 50%. The lower the gross margin will be, and that's simply a case of with the revenue from property, that all falls through to gross profit, whereas on the financial services side, there's quite a significant pay away from revenue. There's quite a significant pay away to advisors and to introducers. So the more financial services represents of the overall revenue, the lower the gross profit will be affected. The other factor is, and this is intended from our point of view, is that on the financial services side, we've tried to shift the model more towards what we call business partners. So business partners operate a bit more like our franchisees do on the property side. They run their own business, they take responsibility for doing their own admin, progress chasing the mortgages that they put in place. You know, they effectively are more self-sufficient, and in being more self-sufficient, they earn a higher rate. The other type of model, we do operate this as well for some advisors. They might be self-employed, they might be employed, but there we're doing the admin for them, and that has a higher operating cost for us. But obviously they earn a lower margin. So in moving towards the business partners more, that has an impact, and you can see that impact in the financial services gross margin moving from 24 down to 22. On the administrative costs, and I think it might be Stephen P had asked a question on this. The operating costs have gone up, and I'll cover that in a little bit more detail on the next slide. But we've seen lower profit levels in this first half, which was as expected, And this is due to the normalisation on two fronts. One, the normalisation of the sales market, which we all anticipated. And the other part was also anticipated was an increase in the operating costs, because when we compared to the first half of 2021, our head offices were working, people in our group position, group functions were working entirely from home. We weren't driving out supporting franchisees, so there was a big change in cost in relation to those things. The only other point to make is on the taxation, not the most exciting line, but in the first half of last year, we had an extra 300,000 of corporation tax, and this was us reflecting the impact of the 2023 corporation tax rise from 19% to 25%, and the impact that would have on deferred tax. So we recognised that at the time, given everything that Liz Truss has promised, and I think somebody has asked about what impact we think that Liz Truss' appointment might make. Well, one thing she has promised is to reverse some of these tax increases, so we might see that unwind sometime soon. So if I just move on. Just a little bit more detail around the movement. So gross profit was up 500,000. The acquired property networks added 600,000. The acquired financial services networks added 200,000. And the underlying business went back by 300,000. So lettings was up 200,000. Sales was down 400, and financial services was down 100,000. Both of those two elements being relating to the normalisation of the sales market. Our management service fees, which are our key recurring revenue stream, if you like, from our franchisees, that went up just a little bit from 5.2 to 5.3 million. And broadly, we saw a 5% increase from lettings, net off a 12% reduction in the value of MSF and sales. Another key line of income for us is from our corporate offices. So if we wind back to the start of 2021, we owned two corporate offices. That's the two in Grantham, one trading under as Belvoir, the other one traded as Newton Fallowell, and we've owned those for kind of ever and a day. And intend to hold on to those two. But when we acquired Nicholas Humphreys at the end of March last year, that came with three quite substantial corporate offices. So we've seen a full half increase revenue in this half compared to just 3 months last year. So those acquired networks added 400,000 to corporate office income, whilst the two underlying businesses saw a reduction of 100,000, and that was entirely due to fewer sales transactions. The Newton Fallowell office in Grantham is a very strong estate agency office. So just drilling down into the admin costs in a little bit more detail, which hopefully will answer a couple of the questions that have been raised. So admin expenses were up 1.2 million to 5.4. The businesses that we've acquired added 700,000, so that accounted 700,000 of that. The acquisitions that we did in the first half, the professional fees associated with those acquisitions was about £100,000 higher than the same professional fees last year. There was a £100,000 increase in share-based payments. And if you strip out those, the underlying overheads actually increased by 300,000. The payroll, excluding the share-based payment, was actually up 5%, and that effectively reflected the cost of living rise that we'd given to our staff, and other overheads had increased by 14%. And that was entirely as a result of operations returning to normal post-lockdown. So if I look at things like, the lines like travel and motor expenses, they basically went up sixfold from being, travel, might have been £6,000, in the first half of last year, and went up to 36. And that is literally a case of we're spending more time, obviously, on the road this year, going around and supporting franchisees. One of the things I did earlier on in the year was when we were actually putting our budgets together, and we're pretty much in line with our budget. So as you know from what we said, when you look at the overheads, clearly they've gone up compared the underlying overheads. I'm not talking about the acquired bits. If we strip out the acquisitions, the underlying overheads in the first half of 2022 compared to 2019 are pretty much up around 10%. And if you think about that as an increase over 3 years, it would be about 3% per year over each of those years. So quite a normal level of increase. The problem here is the optics, and the optics are obviously they reduced quite heavily during COVID, and now they're returning to normal. So if I just look at the balance sheet, so the intangibles have increased by 3.3 million as a result of the goodwill that we acquired when we bought Mr. and Mrs. Clark, Mr. and Mrs. Clark and Time. Another feature of acquiring Time was that the UIC balances have increased. So just a reminder that UIC stands for Unearned Indemnity Commission. So this is where we sell a life protection policy. The client can cancel that policy. If they cancel that policy within 4 years, there's a clawback of commission on a straight line basis. So all the commission is paid up front. MAB receive it up front, they pay us our commission up front, and we pay the advisor their commission up front. So there needs to be some recognition that there's a liability, which we do in the balance sheet here, but also MAB withhold funds from us to give them some protection. And so that money is held in a bank account with our name on it, but under their control. So those balances have increased as a result of acquiring Time. On the net debt, cash is up to 5.7 million and the bank debt is reduced to 8.3 million, leaving net debt of 2.5. We have a final bank loan payment to make of 7.9 million in March next year. And we forecast that we should have the cash reserves to settle that. But equally, we are also talking to HSBC, who are very supportive of providing new facilities if required to fund further growth. They'd very much like to lend us some more money, and we will be as a board will be making a decision over the next couple of months as to what sort of facility we may wish to put in place. On the cash flow, we're still very highly cash generative. 97% of our EBITDA converted into cash. We spent £3 million on Mr. and Mrs. Clark and Time. That was net of cash acquired. Just to note that in July, when we did the completion accounts for Time, we paid a further 900,000 over to the vendors. During the first half, we paid a final dividend on 2021 of 4.5 pence, which had a cost of 1.7 million. And we've announced an interim dividend for 2022 of 4 pence, which is the same as we did last year. Just a final slide coming under our sort of ESG heading, our focus on our people. We did a staff survey in the first half of this year, which is the first time we've done such a thing. And it was quite interesting getting the feedback, sort of seeing what was important and less important to people. And Dorian and I, we sat down and we pulled together some ideas of things that we can put in place for staff to enhance their package, or to give them options of things like, things that they can use that they might like to take advantage of that we can offer. So I think it was quite a good exercise getting that feedback, and that's something that we'll look to do on a regular basis. So I think if I pass back to you, Dorian, for the operational review and market update. Yeah,
that's great. Thanks, Louise. So what I'll do on the next handful of slides is just talk a little bit more about the operation, and I'll move straight into the sort of the markets that we're operating in. Just to answer one question before I sort of move on, just a fundamental question about franchising. Somebody's asked who pays the who's responsible for the heating of franchised offices? You know, if Belvoir, it says if Belvoir 400 plus offices at an incremental cost of 4k per office would hit PBT by 1.6 million. The answer to that is really straightforward, that franchisees are responsible for heating their own businesses. We don't carry their office costs. Okay, so on to the operation. I'll touch on sort of office numbers again within this one. So So the property division, first of all, and we've opened in 6 new territories. So in H1 last year, we had opened in 2, and some of those new territories will be by means of acquisition. Again, another question was around how is the business integration sort of program, which really is us trying to attract agents to come to us and convert to us. That was something we launched a few months ago, and agents, if they want to, they can just sell their business to us. But again, if they want to, they could always join us and rebrand and make the most of the benefits that the network brings. That's not historically something we've ever really been involved in, but it's very early days for us. We are making that proposition available to agents, and 3 of the extra territories that we opened in H1 actually were by means of acquisition, where an existing franchisee has found an independent in an area where they're not operating in, and they've acquired that business, rebranded it to Belvoir or Northwood or Lavelle or wherever, and that business then continues as a franchise. So we're kind of already doing so in terms of business integration, as I say, there are 2 ways an agent can a non-group agent can engage with us. One is that they can sell to us, and other ways that they could convert to us if they wish. And we've put some incentives around that. The latter is something that is very new, that we're just starting this year. So the portfolio of managed properties, I mentioned this earlier, so we're up to 73,300. The reason that our assisted acquisition program, which is where we help franchisees to acquire competing letting agents, the reason it's so important to us is it helps drive the growth of the underlying lettings portfolio. So property numbers are up by about 18. We added around 1,800 properties. Excuse the siren behind me. 1,800 properties to the portfolio in H1. As the acquisitions by franchisees start to complete through H2, you will see the portfolio number increase. But yeah, so lettings to sales ratio is a question that I've had for years and years. When we first listed, if I go back 5 or 6 years, our lettings to sales ratio has always been around 80-20. So 80% lettings, 20% estate agency. And of course, last year, with more estate agency transactions, that ratio changed to 73-27. And I had a load of questions around that. People saying, Dorian, do you think it will revert back? And it has reverted back. So property sales have fallen away back to normal, and the lettings book has grown as well. So we're now back to broadly speaking 80-20. We've got 15 franchisees exceeding 0.5 million of revenue just in the first half of this year, with the largest at 1 million. 58 franchisees have got more than they've got more than one office, so they've got 2 or more, and 22 have 3 or more offices. The largest has around 5, so we don't have any franchisees with 10 or 20 outlets. That's not really reflective of our type of franchising. And on the financial services side, the number of advisors is up 80 to 301. We now represent 16% of Mortgage Advice Bureau's advisor base, which we're happy about. MAB is happy about, and we continue to work very closely with Mortgage Advice Bureau in a partnership that both parties are very pleased to continue developing. Average FS income is up per advisor. Number of written mortgages is up, partially due to the acquisition, partially due to organic. And the ratio, no surprises here, but the ratio of mortgages written for purchases compared with the number of mortgages written on the remortgage side has now reverted to 61-39 in terms of a ratio. So purchases are falling away in terms of mortgage numbers, and then remortgages are increasing because I suspect if you were thinking about fixing your mortgage rate 6 months ago, I imagine that the last couple of months have forced you into a action, and we are seeing more business coming through on the remortgage side, which again was something that we forecast last year. So just to drill down into the markets, and I'll try and answer some of the the property type questions here as well. So on the rental side, I appreciate it can be quite difficult to work out what's happening on the sort of rental side. So what we're sort of showing on this slide here is, firstly, we're showing rental growth since 2016. So average rents have gone up from 900 to sort of 1150. That's national. Within that does disguise a number of regional variations, but ultimately you can see that rents have increased over the last 5 years, but not hugely. And the reason I sort of emphasise that is that even if rents on new tenancies are 10% higher now compared with 12 months ago, an average tenancy lasts between 3 and 4 years. Therefore, it takes years for that new tenancy inflation to flow through to existing tenancies. And there are lots of different ways to track rental inflation. One of the ways is that you can track it via Rightmove and Zoopla, who are reporting anywhere between sort of 8 and 12% rental inflation on advertised properties. Then you've got the sort of point of a reference. So when a tenancy agreement is created, a tenant is referenced, you can also track rental inflation there. That's also sort of saying 8 to 10% increases year on year. And then you've got rents or rental inflation across existing tenancies, which is tracked by ONS with this vast calculation that they do. And they're saying that rents have increased up until the end of July by around 3%. Compared to the previous year. It's actually slightly higher than that now. Up until the end of August, it's sort of maybe 3.2%, that sort of region. So you can see that the rents on new lets are feeding through, or starting to feed through, to rents on existing tenancies. So the fact of the matter is that you're going to see rental inflation over the next 2 to 3 years. I appreciate that affordability plays a part in that, and we're not trying to say on this slide that rents are affordable. We just put that the percentage of income spent on rent is actually been pretty stable, since 2016. I remember when COVID first happened, and we had a lot of investor meetings in that sort of right at the very start of COVID, and it sort of feels that I think investors might be concerned that affordability of rents could have an impact on our business model. It didn't during COVID, and yet at the start of COVID, people said to me, well, surely 40-50% of tenants won't pay the rent. What we find is that tenants pay the rent over and above everything else, the same as I pay my mortgage over and above everything else. And tenants want to keep a roof over their head because there aren't any alternatives. If you're not looking to buy, there aren't any real alternatives now, apart from if you exit the rental sector, or if you lose your rental property. So that just gives you just some sort of helpful pointers really on what's happening on the rental side of the market. One of the questions was around the size of the rental sector. Is it sort of increasing or reducing? Well, over the last 10 years, the rental sector is 15% bigger now than it was 10 years ago. And again, that hides some sort of variations. And in England itself, there are around 4.4 million rental properties in England. It's been as high as 4.6 million rental properties back in 2016-17. It's fair to say that there have been a number of government policies that have favoured home ownership above being a landlord. Therefore, home ownership has risen from 63% to 65% over the last 5 years, but the number of buy-to-let properties has remained pretty stable. Bear in mind that a number of rental properties were lost in 2016-17, but the buy-to-let sector hasn't grown during that period. That's my kind of point, which brings us on to a supply issue. Over the last 5 or 6 years, our population has increased by over 1 million. Demand for rental properties is significant. We had somebody on a call earlier who had just let a property in London, and they had 40 viewings on the property over a weekend. 20 people apply for the property, and either 5 or 6 people made offers above the asking price. And the competition for rental properties is very fierce. Another one of the questions was around Liz Truss and what might she do. I think at some point government are going to have to address the supply issue on the private rented side, or rents are going to continue to go up. I think it's going to be one or the one or the other. There have been lots of policies that have discouraged landlords. It wouldn't take a lot to encourage landlords, but we also need a steadier property sales market where first-time buyers aren't sort of out competing landlords. So what I'm kind of coming to is, if the house sales market sort of flattens off and growth falls away in terms of house prices, in many ways that's actually a better environment for landlords who, on one hand, they can acquire a property at a better value, and on the other hand, rents are going up, so the yields are improving. So yeah, we are already receiving more inquiries from landlords who are looking to buy properties because the demand is so high, and it's always been demand led. You know, if there weren't any tenants, there wouldn't be any buy-to-let properties. Is sort of the point, and clearly we need lots more buy-to-let properties to satisfy demand. So that's just a bit of information on the letting side. If you want any more detail, please, fire a question across. So on sales, I have touched on this earlier, and this just illustrates it on a graph. So I said earlier that a normal level of property transactions is around 1.2 million sales a year, and it was 1.2 million, as you can see on the graph, from 2016 to 2019. This is a quarterly graph, so it shows number of transactions per quarter. You can see that transactions fell off in 2020, spiked in 2021, and in 2022 they've returned back to pre-COVID levels, so exactly as we forecast 12 months ago. House price inflation is also starting to fall away. I personally don't think that house prices have been running away over the last few years. They may seem to be running away, but if you look at the numbers, house prices this year are up 7.8%. Previous year it was 10.8%. It was last year when the demand was very high. 2020 it was 8.5%, but the prior year, 2019, it was just 2.2%. And if anybody with long memories may remember, pre-2007, properties in some areas trebled in value over a 10-year period. That absolutely hasn't been the case over the last 10 years to date. It's a very different market. Okay, so just to give you some colour around the mortgage market. Again, different graph this time. So the blue line just shows house purchases in millions. This is mortgages that relate to house purchases in terms of the amount of the advance. So you can see again, 2020 there was a fall off. Then it climbs quite steeply through into 2021, and then house purchase mortgages then fall off up until sort of this point we're at now. But you can see the red line, which is remortgages, follows a different pathway, and you can see that, again, no surprises, remortgage numbers are increasing. So we're 20% up in financial services revenue. We're very confident about the FS side of the business, in that we see that as a great way of continuing our growth, sort of hand in hand with Mortgage Advice Bureau, and when we built this mortgage business pretty much from a standing start in 2016, 2017. So just to a recap on the investment case, I've mentioned franchising quite a lot through the presentation, and I make no secret about the fact that I'm hugely passionate about franchising. I think that set against a branch manager, a franchisee will outperform a branch manager hands down. So skin in the game, passionate about their own business. If for example, when a franchisee takes on an acquisition, our franchisees work around the clock, 7 days a week if they need to bed that acquisition in and make it work. Paid staff tend not to behave in the same way. So franchisees really are passionate about their business and passionate about growing their business. EPS, so half year EPS more than doubled in the last 5 years up until this point. Staff was sort of mentioned earlier, and staff turnaround and salary pressures. I'm very pleased to say that we've got 3 exec directors, 2 of them are here today, and then behind us we've got 14 operational directors who essentially run all of the brands that I mentioned earlier. So we have a managing director, for example, in Belvoir, we have one in Newton Fallowell, we have one in Northwood. These are our senior managers, and we haven't had a senior manager leave us or change since pre-COVID. Our management team is rock solid. 60% of our gross profit now comes from recurring revenue, which is the core lettings business, which hopefully you will find reassuring. And in terms of FS, 1.7 million of gross profit now comes from our financial services business. Acquisitions, I mentioned earlier, we still remain very acquisitive, and it's fair to say, and Louise will support this when she comes on, that we could have done more corporate acquisitions in H1 this year. We just decided to be a little bit sort of cautious around the prices that we're paying for corporate acquisitions, because we suspect, well, from experience, we know that the sellers of corporate acquisitions are valuing their business on a very active sales year and a very active property market last year. We expect that their expectations may come down slightly, and so we could have done more deals in H1, but just chose to wait a little bit longer. Which brings me on to the final slide. I actually think he's here in the audience, but we, as part of our sort of future strategy, we see growth potential in most parts of the business, definitely from the franchise network. Financial services, we're still very committed to growth, and we are always interested in sort of additional growth areas. We appointed, I'm very pleased to say, John DiStefano joined our business as chairman. We announced it today. John is the ex-CEO of Telford Homes, has a glittering track record, and I think it's very refreshing to have a chairman. I won't say he's young, because he's the same age as me. I don't think we're allowed to say we're young anymore, but I'm 48, John's 48, and it's just refreshing to have a sort of, a more youthful chairman on board with a different perspective. More importantly, John is a build-to-rent specialist. He's an expert in that field, and that's a field that we will look into, as part of our sort of future strategy. So we're in a good position as a business. Our growth has continued. We've already said to the market that we're in line with market expectations so far this year. We outperformed market expectations in 2020. We delivered on expectations in 2021, and we're on track so far to deliver the same in 2022. So that sort of brings the presentation to a close. What I'm going to attempt to do now, if Louise wants to come and join me, is Louise, while I'm on the mic, if I run through some of the property ones and pass them back to you to run through some of yours, and we had a pre-submitted one that we're keen to answer. So I've covered the question about, do we anticipate a reduction in landlords? In fact, so someone's asked, do we anticipate that there will be a reduction in landlords due to bad landlord legislation? And is there any reduction in landlords generally? So I've already said that there isn't particularly a reduction in landlords generally. There are the same number of properties now as sort of pretty much as there were this time last year and the year before. We have lost some properties from the sector over the last 5 or 6 years, and the numbers aren't up to date. They're sort of, there's a 6 to 12 month lag in the way ONS puts the numbers together. What we have seen is, over the last 6 years, increased regulation. Some of it's a good thing, some of it not so good, if you're a landlord. And what is coming downstream, if you're very interested in landlord regulation, is something called the Renters Reform Bill. That there are various parts to this bill. It's currently in consultation. It's probably going to happen, and it's probably going to happen in 2024/2025. And you may have read parts of this bill in the press already. Part of the bill refers to pets in properties, so landlords won't be able to arbitrarily refuse pets in properties. They've got to have a really good reason for refusing, which I actually think, as a landlord, I'm a pet-friendly landlord. I'm also a pet lover, and I've rented with pets. So, I'm not one of those landlords who's sort of, against that in property, but I'm also conscious that, pets can do more damage to properties, and the amount of deposit has been restricted by government in the last sort of few years. So, most landlords kind of want to do the right thing, but this legislation in some parts can be quite useful. But the important part of the Renters Reform Bill to me is that, at long last, having an ombudsman sitting across the whole of the rental sector is in this bill. So it's something I've personally been calling for years. I used to sit on the board of the property ombudsman. I did that for 5 years. And the nuts and bolts of this is that if a tenant rents through a letting agent today, they, by law, have access to a free property ombudsman scheme. And the property ombudsman scheme has teeth. The ombudsman can make an award against the agent of up to £25,000. So quite a significant threat of getting something wrong. If you rent through a private landlord, and of the 5 million rental properties in the UK, around half of them are looked after by a private landlord, and about half are looked after by a letting agent. So if you rent through the half that are looked after by private landlords, you have absolutely no redress if something goes wrong, apart from via the courts. Now, you've got some redress if there are sort of environmental issues with the property, such as mold, damp, etc. But in general terms, you have no redress, no access to an ombudsman. Government have said they're going to change this. The bill's out, it's being consulted on, and we suspect that will happen in late 2025, late 2024, or 2025. The reason I wanted to mention that is that it's important to us as a business that properties are managed properly, and increased regulation, although it may not be popular with some landlords, from an agency perspective, I suspect that will have a good impact on our business model. So I just wanted to flag that up. That was one of the questions that we've had. Another question, sort of for both of us, really, Louise. Given the final debt repayment in March 2023, if any distressed agents want to sell, will you be in the market for this? Well,
I think we kind of covered that on the basis that we haven't, we've got the opportunity to take on additional funding from the bank, and it's just really at what point we decide and what facility we want. There's no reluctance from the bank's point of view to lend against our strategy for growth.
Exactly, and we certainly wouldn't ever miss any of those opportunities now.
No. Shall I just quickly take the one? There was one about our reported EPS and what goes in the ThinCap note. The difference is that ThinCap will adjust the earnings for things like amortisation on acquired intangibles, and they'll remove the share-based payment. And any other exceptional costs to do with making acquisitions. So their EPS is an adjusted EPS, whereas ours is absolutely, the real figures, the actual figures after whatever, all the normal bits and pieces that are accounted for.
Louise, do you want to carry on and do a few more questions?
Yeah,
you're on the mic, and I'll come back.
The overheads. I think the overheads were covered in the presentation sufficiently well. The sort of valuation multiples that franchisees are paying, did it change post-COVID? It did go up last year. Some of the deals going through where the multiples were higher, but I think we're starting to see them sort of come back to more sensible levels now. So somewhere between 1 and 1.5 times lettings, I guess. Dorian's covered the heating. We talked about admin. It's difficult to say. It's not easy to just say if you just look at this for the admin cost of the first half, and is that the sort of like, would it extrapolate to the full figure next year? The problem there is the different acquisitions we've done, like for example acquiring time. There's overheads to do with that business, so that needs to come taken into account. With trying to find a franchise solution for the franchise out in the Nicholas Humphreys corporate office shops, and one we're quite close to doing. And now those corporate offices are quite large and have quite a high cost base. So that changes the dynamic. So it wouldn't be as simple as saying you can just take the half one figure and annualize it. There's too many moving parts, to be fair.
There are a few questions from Henk as well, and I'll do Jonathan's if I can. So,
John, could you just do the one about the business integration model?
Yeah, I mean, so I think I think you did. I mean, it's so a little bit more about the expectations for the business integration model. That was the one, Louise, where I said agents so we're out there actively canvassing. We send out thousands of canvassing letters, and we sort of held our nerve really with franchisee acquisitions during 2020 and 2021, and we kept all of the team on our payroll, and we've got 5 full-time people who work within the acquisitions department, and we kept that team in situ, even though the number of acquisitions had fallen off. the reason I wanted to mention that is that the same team is out there canvassing for the business for businesses who might wish to integrate with us or join our franchise model. It's quite early. I suspect that some agents will want to join us and sort of rebrand, but actually I'm equally as happy if they want to call us and sell their business to us, because that drives MSF growth, recurring growth going forward. So it is very early yet, but we do absolutely have the team in place to start making some headway in that.
So one from Scott about have we gone back to our pre-COVID ways of working? Not entirely. Yeah, I think it's probably like a lot of businesses, it's a hybrid. So for example, on this Investor Roadshow, historically we would have been down in London for 4 solid days, but this time around we're sort of doing 2 days in London and 2 days from the office. And I guess it's similar with our supporting our franchisees. Some of the visits we're doing are face-to-face, some of them are getting support, you know, in between those physical visits remotely. So yeah, a bit of a mix, I think, on that one, and hopefully keeping some of the positives, but without remaining totally isolated and remote. Interesting one about the buying back shares in related to stock-based compensation. Well, we won't have that problem. I don't think we've got some options that could be exercised. I think probably not until January. I think it's something that we could consider, and we'd obviously just have to have a look at what made sense at the time. There's one about the gross profit on the acquired businesses and it having a return of only sort of 12.5% EBIT level. It's sometimes not so easy because the figures obviously in here are rounded to round point whatever, 100,000s anyway. But there's often our costs involved when you first acquire a business of assimilating it and settling it down. And some of the costs, although there's a revenue, there's also a high cost in the the acquisitions that we've done that have got corporate offices, which is why we want to franchise them out. But we would look to sort of work on that, and where we can reduce the admin expenses, we would do so.
Yeah, shall I do, if I do Jonathan's as well. So Jonathan's asked, do you currently have an active pipeline of significant prospective acquisitions? I think I'd probably at home drawn and quartered if I said, you know, we've sort of got deals that we haven't announced, but, you know, we've always got, so on the franchisee side, what I said earlier was that we've completed on 2.2 million of franchisee revenue, and we've got 4.4 million of franchisee-led acquisitions in a pipeline. So that's the franchisee pipeline, and that continues to grow. You know, bear in mind it was a fraction of that size sort of 6 months ago. And then on the corporate side, you know, there are always businesses that we sort of either in talks with or we're, you know, talking to, you know, relatively modest businesses, and, you know, nothing may come of the discussions. But as Louise sort of mentioned earlier on in H1 this year, we could have made more corporate acquisitions. We just felt that, you know, some of the multiples and some of the, you know, the lack of protection in place didn't make those deals viable from our perspective. But I suspect that sellers, you know, over the next sort of 6 to 12 months of the potential corporate acquisitions will be a little bit more realistic in their expectations. So if that helps, Jonathan, I'm not sure whether it helps or not, but best I can say at the moment.
There's a good question from Henk about the, where it starts off talking about, do we support franchisees in setting prices? We don't actually, well, we've advised franchisees on setting prices or how they run their business, but we don't enforce anything on them. That's very much down to them. But the interesting question, you said that you thought the organic increase in lettings MSF seemed somewhat underwhelming versus the increases in rents and general inflation. Now, the increases in rents are definitely there, but you've got to remember we're across the board. So the increases we're seeing, you know, from a management fee point of view is more like the ONS figure at 3%. It's not the sort of 10% rises that we're seeing on new tenancies, because we earn our fees across all tenancies. But what we're seeing in addition to the increase in rents is that it's also deterred people from moving. So we haven't seen as many tenants move as we might normally see. And there are, although we don't earn fees from tenants when they move, there are fees that we often earn from landlords. So we haven't seen the same sort of income from tenants moving that we would have seen, because they're not moving as much as they would have been if the rent on new tenancies wasn't so high. So that's had an impact on that side.
Just to add to that, Louise, what we also saw sort of, in H1 is the tail end of sort of, some landlords selling because their property market, in their view, the property market sort of house prices may have reached a sort of peak. So franchisees have also had that to deal with. But now it's starting to return to normal. I suspect that the inflationary increases will sort of start to steadily flow through if the market remains the same. So I think that's. I think we've got just one more. Actually, we actually have got through all the questions, which is great. How do we? This is from Scott. How do you envisage Belvoir entering the build to rent arena? That there are two different ways, really, Scott. One is the most obvious way, and that's with pitching for build to rent business to manage some of these developments. That's one area that we're not currently involved in, but we would quite like to be involved in. Then the other area, the much braver way, is that you jump into the feet first and get involved in build to rent. That's not something on our short-term sort of radar, but we do intend to debate build to rent pretty hard in a strategy meeting that with John on board too at the end of this month. So it's an area that we're keen on, but management, I think, is the short answer to that. Property management, which we're one of the few companies nationally that can sort of offer national property management.
Dorian, I might just jump in because, as you said, that's perfect timing. And I know you have a train down to London this afternoon. So thank you very much indeed for your presentation. And if I may, Dorian, I know that investor feedback is particularly important to you and Louise and the rest of the board. I'll shortly redirect investors to give you their thoughts and expectations, but perhaps just to close up with a few closing comments, and I'll redirect investors for their feedback.
Yeah, that's great. Thank you for that. I think just to say that we have a very loyal sort of investor base, and over the last few years, we've delivered good returns to investors. Somebody said to me earlier, Dorian, you seem very steady and sort of sanguine and confident really about the sort of sector, and actually I am, because we traded successfully through some pretty challenging times over the last 15 years. And the lettings part of the business especially tends to perform when other parts of the business, such as property sales, tends to sort of fall away. If property sales do fall away somewhat, but yeah, we're in line to meet expectations this year. We're very confident about the business going forward.
That's great, Dorian. Louise, thank you very much indeed for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Belvoir Group PLC, I'd like to thank you for attending today's presentation and may wish you all a very pleasant evening. Thank you.